record. And I want to share my screen, do a couple introductions, and we'll be right on the way with it. One of the purposes of these meetings are to learn to know each other better, to have a pre-existing relationship, right, for investing. But we're not selling anything on these meetings. There's no solicitation of any deals. It's not financial or legal advice. It's simply professional sharing what we do, and to hopefully help educate people. And I'll guarantee it'll be well worth your time this evening. And by the way, you're welcome to ask questions throughout the meeting. Greg has committed to answering questions, and Asif and I will help as well as we go through the meeting. Our speaker for next week is Matthew Pastrano. He's with the GREA broker firm. And so he'll be giving updates on the current market next Monday evening. And introduce the Eagle City partners here. Nikki and Dr. Sanjeev Mall are on the team. They're also here in the Dallas area. Asif Kumar is on the call as well. He's part of the Eagle City team. And we are looking for 80 to 200 unit B and C class deals in the DFW market and the surrounding areas. And so if you all have great deals, bring them on. And so introduce our amazing guest speaker today, Greg Butcher. Greg is an experienced real estate investor who lives near, I should have asked you how to pronounce the city there, Greg.
It's Temecula, California.
Temecula, California, with a Bachelor's of Science Business Administration from the University of Oklahoma and an MBA from the California State University at Bakersfield. He began investing in single-family homes during his career as a Marine Corps officer, but struggled to learn how to scale them. His aha moment was learning about the power of syndications and the scalability of commercial real estate. He joined a leading national multifamily education and mentoring program while preparing to retire from active duty as a lieutenant colonel in 2015. And has since invested in over $170 million worth of multifamily real estate, spread out over 1,100 units as a general partner and more as a limited partner through his company, Blue Sky Equity Partners. He is a co-organizer of the National Apartment Investor Community Meetup group in the San Diego area and a coach with Vertical Street Ventures Academy, so he can share his passion and help others, particularly veterans, get their start in commercial real estate investing. Greg, we are excited to hear more and learn more from you this evening. Go ahead and introduce yourself and tell us more about how you got started.
Thank you very much, Herb. Appreciate that. Thank you for the kind introduction, and happy to be here. Happy to see a couple people's faces I recognize here on the call too. Rick and Edward Valdez there. So I started getting into commercial from single family right as I was retiring off of active duty Marine Corps. My first year in the program that I joined, I really just invested passively. While trying to figure out how it all worked and understand underwriting and all that kind of thing. And then my second year, 2016, is when I buckled down and got serious about trying to be a general partner and find a deal as a GP. So the way that worked is I partnered up with a couple of guys in the program that I joined they were Dallas based. I'm originally from Oklahoma, and I actually started looking in Oklahoma originally. Here I was living in the San Diego area, and Temecula, by the way, is just north of San Diego, about an hour or so. But so I was living in the San Diego area as a newly retired Marine Corps officer. I had this telework job, still working for Department of Defense, working from home, and it was pretty hands off at the time. So I felt like I was living a good life, and now it's time to build up my my real estate portfolio even more. But the problem was I'm not going to invest in California. So it just doesn't make sense. You know, there are some markets in California where it might make a little more sense financially, but you still have to deal with the adverse landlord tenant laws there. So I'm just not going to do it. So I had to think about where it made sense for me to focus on, and Phoenix was about the closest market to me that made any sense. And I knew it was an up and coming market at the time. It was gaining steam. So I decided to focus there. And those two guys who I partnered up with for my first deal, they had deal flow coming to them in Phoenix, but no way to get out there. And so I started, I said, hey, I can get out there really easily. I'm your guy. So we formed a partnership up that way. And after a few LOIs, we finally got one. It was 120 units. And as soon as you hear the price tag, you'll know I'm dating myself here just a few years. So this is only 2016, but we got it under contract for 66 a door. So $8 million for 120 units, C-class, mid-1970s construction. So we held that. Yeah, those are the good old days, right? Yeah, so we held that for a little under 2.5 years before we sold it, and we exceeded our 5-year pro forma in less than 2.5 years. So everyone was pretty happy about that. I had to take a little bit of a pause from getting into for the properties as a GP for a little while, because I had to move out of state for a year for family purposes, and then came back. And when I got back, then I got busy about getting into some more deals and started doing it. Picked up a property in Tucson in 2019, and then missed 2020 because of COVID, and kept on coming in second and best and final rounds. And then 2021, we got into a few more deals in 2022. So currently have 7 properties as a GP under management, with that first one having gone full cycle. So 8 total. So yeah, that's kind of where I'm at. So I've been a co-sponsor on deals in Houston, Dallas Fort Worth area, and also one in Tucson. My biggest markets is my best market knowledge is in Phoenix and Tucson, and then I also have one deal as a lead GP in the Denver area also.
Oh wow, that's a lot of activity in the last few years.
It has been. So keeps things interesting.
Wow, yeah. I'm excited for you to hear more from you, Greg, about your management process. I know that you're very, very good at that, and you have extensive experience in that. And by the way, anyone on the call, you're welcome to raise your hand, unmute yourself, ask a question politely as Greg is going through his presentation. So, but yeah, I'm excited to hear more about your, I heard you go over that, Greg, at an event recently, and it was very in-depth in a very systematic way that in the importance of asset management, right? Because that makes or breaks a deal.
Absolutely true.
Ruined, right, by poor management.
Yeah, when I first got into that first deal as a general partner back in 2016, we were in a very different market than we're in right now. Back then the market was compressing, prices were going up, cap rates were tightening up, and when a market is doing well and climbing like that, the market can gloss over either lackluster or just mediocre asset management. And actually, I kind of look back on how we did that very first property, and I have to kind of laugh because there's a lot of things we just didn't know yet, and a lot of things we learned the hard way, Okay. But today, very different market. Right now, the two biggest things that can mean make or break a deal is the debt that you place on the property and your asset management. So it just comes down to that, and I personally believe that every single multifamily investor needs to understand the basics of asset management. You know, it is, whether they are every general partner, at least every general partner needs to understand asset management, and it doesn't matter whether they're the ones doing it or not. But ultimately, at the end of the day, they're the ones who are responsible. Their team is responsible, so they need to make sure they understand whether it's being done right or not. So that's why I'm a huge believer in it. And I'm not going to say I'm doing everything perfectly. I have room for improvement too, but you know, there are certain things that I keep at the top of mind, and as I go through with properties and everything, and you know, happy to pass some of that on.
Yeah, tell us some things that you watch for or look for in especially for passive investors looking to invest in other people's deals, right?
Yeah, absolutely. So the first thing I'd say is, so I have kind of a little, you know, I come from a military background, so of course we love acronyms. So I have this little acronym I have is called the M3C3 Asset Management Principles, and it's not any kind of secret sauce or anything like that. It's just kind of a mnemonic, really, for some of the most important things that I think people need to consider. Especially on the GP side, but you know, but LPs need to be asking the right questions about all those kind of things too. So this basically is there's 3 M's and there's 3 C's. So the first M is manager. Okay, and the whole thing there is your property management company is your most important partner in asset management. You know, a lot of people talk about your lender being your biggest partner on a property, and that's true because they provide, you know, the majority of the financing. But you know, they don't help out with asset management. So as far as running the property and operations, your property manager is your most important partner on the deal. So so a few things on that is, you know, when you have to change management companies, it takes time. So it takes time to change direction of a ship, you know. For example, or a speeding train, it takes a while to change that track, you know. So you need to always have a backup property management company, at least one, if not a couple of them, in your hip pocket. You know, have those relationships built and have done that research and figure out what property management companies in your market you would want to work with. And that way, if something happens and you do have to make a change, you have that ready to go, and you're not then just scrambling then to do all that research that goes into those changes. So having a backup ready definitely helps a lot. People are used to when they buy a new property, a lot of people tend to change property management companies right then. You know, they have their property management company that they want to work with in that market, or that they're already working with, and that's when you see a lot of property management changes, is that takeover. And I was used to seeing that in my own properties as well, and that's all well and good. Now we're all used to that. Takes a little bit of time to get for the new property management company to get up on level and really understand the property, have their fingers dug in, have a grasp on things, and usually go through a little bit of decline in your occupancy for a little bit. A few more people move out. And before things get up after, you know, 6 months or so, where you're on, you know, fully, you know, on level ground. But I'll tell you that the best takeover I've had was my Colorado property, which we bought just a little over a year ago. And the reason I attribute to that is because we didn't change property management companies. We continued. Yeah, we continued using the same property management company that the sellers were using. Now, that was our first Colorado property, so we didn't have anyone else, you know, anyone that we were already working with in market. But
that's good.
Yeah. So, but we talked to several, and the sellers were friends of ours, actually. So, you know, we kind of knew what to expect, and it turned out we're the third set of owners that this property management company has managed this property for. Oh. So it has been the smoothest process. There was no big change in occupancy, and there's the manager stayed on site. It was like we just walked in and they already had the ball rolling. They just had to get used to our business plan and the CapEx that we wanted to do and things like that. So It was really it's been really fantastic. So
That's good. That's how our last acquisition here in Grand Prairie, we kept the same property manager because they were managing property for another one of the GPs, and they're doing very well. So that makes it a lot easier, I'll say.
it does, absolutely, absolutely. So a couple other things let's say is when you have your property management calls, it helps to have your whole team on the call. And that kind of depends on the size of property that you want to, that you're working with also, of course. But at the very least, I'd have your site manager on the call and your regional manager on the call. Most depends on if you're doing some small properties, like 10, 12 units, something, heck, maybe you're even self-managing, but at some point, even if you're doing those size properties, at some point to be able to scale, you're going to need property management. So typically you have a regional manager managing your site manager, and they're over 7 or 8 or 9 different properties. So typically you have your regional on the call, you have your site manager on the call. A lot of people don't do this, but it helps, I think, to have your maintenance lead on the call, whether it's a large enough property where you have multiple maintenance guys, and so at least your maintenance lead is listening in, or it's just a single tech. But that way they understand where you're coming from, and they hear directly from you as the owners, and they get that rudder steer, and they hear what your priorities are, rather than playing the telephone game and hoping that the site manager passes it on to that person in an effective way. But at the same time, you have to respect their chain of command too. So, the property management company is your partner, not your employee. And same thing with even though you're paying the salaries for your site team there, they work for that regional manager and ultimately for that property management company. So, I don't ever give instructions to the site manager or the maintenance tech that I'm not also making sure we related to the regional manager. If it happens to be a conversation where that person is just out or whatever, we just make sure we go back and backfill them on all those things that they need to be aware of. Okay, so they can properly supervise those folks. So the question here from Christopher, what the other 2 M's and 3 C's? Haven't gotten those yet, but I'll get to them here in just a minute. The first one is manager. And on the same note, if you are a larger property management team, or a larger asset management team or a larger ownership team, do your property management company a favor, have 1 to 2 max lead people who they are going to work with for asset management, and have 1 to 2 people they reach out to and deal with. And everyone else needs to funnel all their stuff through those 1 or 2 people. The last thing, you don't want to make it tough for your property management company being on a call and have 7 or 8 people chiming in with their own opinions. That's not the place to have debates or good idea type of stuff between the partners. That's for a different call, so that you can present a unified voice to your property management company. And then last here is just what you would expect, I suppose. Trust but verify. Inspect what you expect. Okay, that's something that I learned in the military and kind of carried over from there. And that's enough about managers. So the second M is for meetings. Okay, and that's have organized meetings. All right. Meetings should not take more than about half an hour. If you're in the middle of a heavier CapEx, it might take more than half an hour, or you might separate that into an operations meeting and a CapEx meeting. Maybe they're just back to back or whatever, however you organize that. But don't waste your property management company's time. Every few minutes that you're keeping your site manager away from managing the property and dealing with things, they could be doing other things. All right. And then your regional, don't forget, they have 7, 8, 9 properties that they are doing this for. So they have these same calls for all of those also. So respect their time, you'll get a better effort out of them. focus the meetings on the key issues, understand what those key things are. You don't go through all your reports on the call. Have them used to providing the reports a day ahead of time. Go through those on your own. And that way you can identify the key issues that you need to actually focus time on the meeting about. Okay. Take written notes from your meetings and share them, and use those notes to assign responsibility for action items and hold people accountable for those things. Make it clear who is taking action on certain things, whether it's the owner asset managers, or whether that's the site manager or the lead maintenance tech or whoever. And then my last big thing I have here is to train your team to have routine items sent to you the day before a meeting, and deal with those on your meetings. And then only emergency items in between. That's something that has bugged me on a couple of my properties where we've changed out, a site manager, that maybe a site manager, left the company, and we got a new site manager come in, and they're sending us emails 2 hours after the meeting at looking for decisions on certain things that weren't brought up then during the meeting. I'm like, this doesn't make any sense. We're wasting everyone's time here. And we have other properties that we're managing too. So yeah.
Yeah.
So that
wait till the next week and bring it up, right?
Exactly.
If you forgot, right?
If it's routine, then absolutely. If it's urgent, yeah. If it's something that's more it has more urgency than that, sure, absolutely, go ahead and do that. But those should be the exception, not the rule. So the third M is measure. So we have manage, meetings, and measure. Okay. And so the whole idea here is to measure what you want to manage. And here we're talking about key performance indicators. Okay. Your property management information system that your property management company uses will have certain reports available. You need to be able to run your own reports. Even one or two of my partners, typically, they either rely on me to pull their reports, or they ask the site manager. And that frustrates me to no end, because it's just a waste of the site manager's time. Again, it goes back to respecting people's time, asking them to spend time doing something that we should be able to do ourselves. So understand how to run the reports you need to run. And those reports are the sources for the majority of those KPIs. Some of them may be ad hoc reports, but these are all things that you go over, on a certain amount of time. This is a deep topic, the KPIs, and it's one that I actually, it's more than what I could go into right now, or even put on a slide. But what I do have is, as I was learning asset management, I was always looking for some kind of a checklist of KPIs that I should be looking at on a certain period, a certain frequency, on a weekly basis, monthly basis, quarterly basis. And I saw a bunch of different, lists of KPIs, but I never saw anything breaking it down on what we should be looking at on a weekly, quarterly, monthly basis, that kind of thing. So I ended up making one. And so I'd like to make that available to your viewers here at the end of the call. So it's something I put together, and it's not set in stone. It's my own thoughts, and it's also it's more just as an easy, quick desktop reference, really, because every single property and business plan is going to have different things that you're going to want to look at. So I think it's pretty comprehensive in terms of everything that's on there, but some things I might have on a weekly basis, and that might be too often for you, or certain things I might have on there on a quarterly basis, and you want to say, no, we need to be looking at this every few weeks here. So you have to think about, as you start a new property, what are the KPIs that are most important for that property, for the unit mix, for the age, for your business plan, or is it value add, or is it already is it a core business plan that's already stabilized? You're not doing a whole lot to it. So and think about what it is that you need to be looking at so that you can measure what you want to manage. Okay, so the first C. I'm sorry. Go ahead, Herbert. You're starting to ask questions.
Awesome. Great. Those are three great 3Ms to think about. Yeah, please proceed.
Absolutely. So the first C is cash. and that is just standing for cash and financial management. So this is understanding the financials. Okay, someone needs to have a good understanding of accounting on your asset management team. Okay, and they need to understand both cash accounting and accrual-based accounting, and they need to understand the difference between the two. They need to know how to dig into the general ledger to understand, you know, transaction by transaction what's behind each of the numbers on the P&L or in the balance sheet. You know, every time you get your monthly financials. Should never take the financials that come out from the property management company as gospel just because it came from an accountant, and oh, they must know what they're doing, you know. So the accountant is doing this for multiple properties, so they don't understand the business decisions that are going on behind the properties. So, and they'll misclassify transactions from time, you know, fairly often, especially when you're brand new into a property that you expect that you need to make a lot of changes. You know, towards, you know, after a year or so, hopefully you get to where you don't have to make too many changes, but they occasionally still going to be necessary. So you're going to have to go through and audit your financials on a monthly basis. And I say audit, but really just screening through them and understand if there's anything that needs to be reclassified under a different account. Understand if there's things that are above the NOI, above the line, that should actually be below the line or could be below the line. Because if it's above the line, then it affects your property value. If it's below the line, it doesn't affect your property value. So understand how to manage the income and manage the expenses as you're working with your property management company. Understand the cash flows and the cash requirements. And that's different from looking at the P&L. It's largely based on the P&L, but there are some, you know, balance sheet transactions that affect your cash balance too. So understand your statement of cash flows, understand how that all works together, so you can proactively measure and manage your bank accounts, your cash, your reserves, and plan and make distributions for your investors. And that goes out to my last point on this is budgeting, reserves, and distribution management. So most of us are used to once a year going through a new budget drill and formulating a new budget a month or two before the start of a new fiscal year, which is usually the same as a calendar year. Or it might be based on a year based on when you actually purchase the property. You know, it could be either one of those. But you know, we're used to, especially for Texas properties, especially, I'll say right now, like the property taxes or the insurance might have a big jump. Okay, that happens. All right, doesn't happen as much in Arizona. It's one reason I like Arizona, but it happens more in Texas. It happens in Colorado too. So you know, yeah, exactly. So how many of us, you know, how many of us take another look at how much reserves we need to be having on hand based on our new expense burden that we have forecasted for the coming year? Took me a long time. I'll be honest, it was within the last year or so before that thought even occurred to me that we need to be looking at, you know, revalidating our reserve level based on our expected changes, the changes that happened in our expense levels and our income levels over the past year, and what we are forecasting for in the following year. You know, and some of those larger changes, like in insurance, has been happening a lot lately across the country. You know, that might have a bigger effect on necessitate a bigger change in your reserve balance, and you need to be proactive in planning those things and making those decisions. Especially before you make distributions. You know, you want to make sure you're not putting out too much in distributions, and that you are properly preserving the financial integrity of your business there. So
yeah, that's very important. Yeah, any thoughts, any questions from anyone here on the call? Ed, Rick, Steve, Chris? If not, please bring the other two C's.
Right? All right, got two C's to go. So the next one is construction management. And that's not, again, none of this is rocket science, but just it's important to have someone who is assigned as the lead for construction management, who kind of has an idea what they're doing with these and has done this before. Part of it is for building your rehab budget in the first place. Property by property, I've gotten better about that, but I find that we still have tended to under plan sometimes how much things would cost, which is why it always pays to have a healthy contingency budget in your budget, have a healthy contingency line item in there, because you never know what's going to happen. That goes for during your actual rehab, scheduled planned rehab period, but also for year by year after that. There's going to be things that have to happen that are CapEx related, even after you have completed your rehab plan. If you're holding the property for 3, 4, or 5 years, okay, there's going to be tree trimming that's required. There's going to be unexpected plumbing issues that arise. There's going to be continued parking lot maintenance projects that have to happen. So you need to have a big enough contingency budget to deal with those things, both any overages during the course of your planned rehab, but also to deal with those things without taking them out of cash flow in subsequent years. Because that's the worst thing, is to end up having to take it out of cash flow, because then you're taking it out of your own profits, where you could have planned for it from the very beginning and had things a little bit tighter that way. So a couple of things you need to think about is for unit renovations. Are you contracting them out for third party, or are you doing them in-house through your own maintenance crew? What are the expected costs of all these things?
Greg, Ed has a question, I think.
Yeah, absolutely.
Hey, Greg, real fast. I was curious, is there any calculation or, because I'm very new to this actually, but any calculation that you use to pad your contingency budget just in the event that construction cost does go over? Is there any particular formula or?
Well, what I've always heard is 10%. Always have an extra 10%, but you may need more than that. And 10% might account for overages during your construction plan, but that might not be enough to account for subsequent year CapEx that was unforeseen CapEx type of things. So that's all stuff to consider there, and that's something to talk through with your regional and come up with a proactive budget for all those things at the very beginning. So, does that answer your question?
No. Well, it does. It's great. And I guess my follow-up question to that is that something that even the property manager might be able to help, just saying, hey, this is our business plan. Do you recommend how much on top of that would you recommend in the event that in some cases I understand business or property managers have experience with renovations, so they may say, ooh, you might be a little bit low, short, or you've over budgeted, so on and so forth.
So a lot of that, Ed, also goes back to the property management company issue that I talked about before. I didn't mention it at the time, but most property management companies, unless they're really small boutique level firms, most will have a construction management section. And so you'll either have a person to deal with there who assigned to your property, or there'd be like the head of the department who you can talk to, who has even more knowledge. And those are questions that the regional might have some ideas, some familiarity, but that's something I personally would prefer to go and talk to the construction management section of the property management company and get advice from them. Be asking them about what are you seeing, and talk through the scope of your planned renovations, and how much was this kind of thing going to cost. Do you guys have extra maintenance staff where you can float folks across, and I just pay for the extra labor to do some of these in-house? If so, how many can we feasibly do at a time before we now we have to contract them out third party, or do we have to? Should we be planning on doing this third party the whole time? Do you have the right vendor relationships to be able to execute this and talk? You know, what I would talk through with your management, the property manager side, the regional, is more about how many renovations do you see needing to be able to do at a time? As long as you're just doing the renovations as units become available and not forcing availability. And also in that same conversation with the construction manager about talking through the scope of your renovations, the property manager side of it, or the regional side of it, is what kind of rent bumps can we expect for this? Is this over? We don't want to over renovate for the demographic in the property that you're in. Okay, so is this juice worth the squeeze, or is this too much? You don't want to be spending extra money needlessly. Okay,
Greg, here's something that we do. I recommend as well. To Ed's question, is something that really helps is a third-party due diligence company. And that's what we do. And so they'll give you a detailed report, and the one we use gives us quotes from actual contractors to get everything done that they recommend getting done. And they'll have like a pro forma, like how many years expected life out of each, appliance, or, structural or roof, right? The big items. And so that really helps.
That's a great point too, and thanks for mentioning that, Herb. I wasn't thinking about that because that's not something I see in the Arizona markets. I don't see third-party due diligence companies out that way. I know of a couple there in the DFW area. So
yeah, the Omni Group is really great. Yeah, Brian Amos and his crew.
Absolutely. I haven't used him. I tried to use him on a property we did in Fort Worth a year and a half or so ago, and ended up doing a different one that I was a little less than pleased with, to say the truth. But so I'm not going to mention names on that one.
Okay.
But definitely, Brian was scheduled too far out, or he was like, we just wasn't going to work out. So I knew we were losing out by not using them though.
Yeah, if the question's answered, let's move on. We have maybe 10 or 15 minutes here, or less.
Okay, fantastic. So that's enough about that, I believe, about construction management. And then the last C is community. And that is, all about creating a sense of community within your property. The tenants deserve it. This is where they live. Okay, they deserve this. And breeding a sense of community is going to help with tenant satisfaction. It's going to help with your renewal rate, with their tolerance for any rent bumps that you are trying to achieve. Happy tenants are going to improve your property performance. There's a number of different things you can do. It just takes a little bit of creativity, and some people really love doing all that kind of stuff. And sometimes the site manager might, sometimes the site manager might not. Sometimes you might have to kind of force them a little bit, or do things, take the lead yourselves and kind of lead them. But there's a number of different things you can do, whether it's, we just had a kickoff the summer and pool opening party at one of our properties here just recently in the last week or so. I wasn't at it because I was coming back from vacation at the time, but a couple of my partners were. So they were there on site for it, along with the site manager. And so that's been a good one. We've had a food truck come out to our property before, paid for by the property for a little party. We have, especially during COVID, we'd have pizzas like once a month, for a few months there, as a way to incentivize, getting your rent paid and everything like that. When we were a little questionable on whether that was going to happen yet, we were all kind of sweating it a little bit. There's all kinds of things you can do. We just had one of our Houston properties. They're doing a monthly tenant appreciation event now. They did something for for Valentine's Day that I was there for. They did a St. Patrick's Day party. They did something for Easter. They did, kick off a summer thing for May. So they're doing stuff all the time. There's my very first property. It was definitely a workforce housing kind of property, a C-class. And that was, some of those properties, Christmas time can get a little bit dicey. What can happen is people will prioritize presents over rent, and you'll have your delinquency will jump up at Christmas. And then in January is kind of the same thing until they can get their tax refund. And then in February, they get current and pay their bills. Not the ideal way to do things, but trust me, it happens all the time. So what we would do is we would have a raffle for a flat screen TV, but to be entered in the raffle, you had to have your rent paid on time. So, and it's, spend $500-600 and there you go. And people are like, oh, okay, cool. So, yeah.
Those are very great ideas. Any other questions from anyone on the call? Can be anything.
So what do you think about the current market?
What do I think about the current market? I think it's a tough market, that's for sure right now. I haven't gotten any new properties here in a little while. I've had a few offers to partner up on deals, but I was kind of pushing things off until after the start of the new year. And then the last 2 months is until I got back from this vacation I just went on. So now I have no more excuses. I got to get into property.
Good.
It's tough. There's a lot of discrepancy between buyers and sellers right now. What their sellers are expecting and what it actually makes sense for buyers right now. But
and I'm seeing, I'm getting a call for every day or every week, 2 and 3 from the brokers. Hey man, this is the deal. We have a deal, and the people are coming back. We did the LOI for one of the deal in I think in January.
Yeah.
Right, early January, and the seller is still stuck over there. No, I'm gonna sell in this price, but this is my new LOI. This is my new NOI. I said, I don't care about your NOI right now, because the problem is with me is your NOI for last 3 months is not gonna justify for next 5 years.
That's right.
First of all, I'm not gonna buy for pro forma. You're asking about what is not gonna work with the current interest rate.
Yeah.
And this is what I'm telling my brokers also, that, man, it's just not worth it. You need to bring the deal, which is DSR 1.26 or 1.36, then it's going to work.
Yeah, I agree. And in today's day and age too, while inflation is still higher, our expenses are now rising faster than our rents are, because the rent growth that we had last year was fantastic, but this year is tightening up. So now we're in stagflation territory where expenses are rising faster than our rents are.
And I'm looking some deal, frankly speaking, up to 5 million buy out on the cash.
I'm sorry, say that last part again?
To buy on the cash.
To buy cash only? Okay.
Yeah, because see, my thumb rule is here that I can save 5%, 5.5%, which I'm going to pay to the bank. Right? Plus, I'm going to generate 5% of a cash and cash. It's only for 2 years. After 2-3 years, if the rate go down, we refinance. In 2 years, you're going to save at least 5% interest rate, 6% interest rate.
Yeah, I agree. With this is a tight time right now. We will get through it. This is nothing more than a season, but it's painful until we get there.
So if you guys have seen any deal coming or selling a deal which is around this one, just please contact us. We are aggressively looking, but the market is so frustrated right now.
Yeah. So one property that I'm familiar with, because I as Ed knows, I work do a little bit of work on part time on the side as a coach also for one of the other programs, and there's a student group who's going after a deal recently in Phoenix, and the whisper was roughly, I was just say it was 15 million on this. And when they came up with the, Phoenix is typically higher prices, and it's justified why, but I won't get into all that right now. but they couldn't get past about 10.5 on their underwriting, and they're like, this is ridiculously low. We shouldn't even bother talking to the brokers. I'm like, no, guys, talk to the brokers. Tell them where you're at. Tell them where you're coming in. Ask for feedback. Ask for rudder steer. And it turned out when they did that, the guy told them, no, you know, we already have 3 offers on the table, and yours is good right in the middle of all of them. So that's how big the discrepancy is right now. It's huge.
I have the same condition. I went over there, took the tour. The owner actually knows me. The broker does not know me until that owner will show up and say, hey, yeah, he's from my community. And he said, hey, I already have an offer for 15.3 million. I said, okay, good, man. And then I did underwriting. It's just not come more than 9.5 million. So I go back to the broker, and then broker said, no, they are not going to come back that down. And then after 2 weeks, he called me back. He said, hey, the seller came back and he said that he can finance $2 million to you, right? And he can take down 1.5 million. I said, it's still not working. You are asking too much. Your NOI is not good. Your rent roll is so shady right now. So I need 2 years rent roll in order to be fully audit. And then if it is worth it, I can buy 9.5 or 9.6 million, not more than that. So anyway, people are coming back.
Yeah, it's definitely, it's weird time, that's for sure.
Yeah. All right, guys, I have to go. I have to leave. So you guys continue. It's nice talking to you. Definitely, we will talk more, man. We will work together.
Sounds great, Asif. Great talking to you.
All right, take care. Bye.
Okay, you too.
All right, bye, Asif. Okay, great evening. Thank you, Greg. Thank you so much for that knowledge and input on management. And we have one lucky winner of the $10 Starbucks card. Can't break our habit. So Edward, you get the $10 Starbucks gift card tonight, and I will email that to you within the hour. You simply open your email on your phone and scan the code, and your drink's paid for. So any other questions before we close? Chris, go ahead.
Yeah, just muted. Oh.
Yes, we can hear you.
Great. Hey, great. Thanks for the content tonight. So great. And Super Pie, brother, I sent a comment in the chat box, but I was looking for contact information for you.
Oh yeah, absolutely. Let's see. I'm just pulling up my Calendly right now. I'll drop it in there. So first thing, I'm going to drop 2 things in the chat. One is a link to download that KPI and report checklist that I mentioned. So if anyone's interested, take a look at that. It just has a my thoughts on all the different KPIs that asset managers should be looking at whether on a weekly basis, monthly basis, a quarterly basis, and a few things that should be looked at annually as part of annual budget planning. And then I'm also dropping in here my Calendly, and feel free to hop on my calendar and let's have a meeting. And yeah, absolutely happy to talk to anyone who sees this, and definitely a fellow Marine. I mean, come on.
Yeah. All right. Thank you. Very proud of you, Greg, and Chris, by the way, for your service.
Thank you, Herb. Thanks for your support. Appreciate it.
Yeah. All righty. Well, it's been a great evening, and see you all next week.
All right. Take care, all.
Bye.
Thank you.